Good afternoon, everybody. My name is Praveen. I'm the CMO here at Think 360. A good afternoon to everyone and a warm welcome to our webinar today, Underwriting 2.0, the great shift to adaptive risk, intelligence, and continuous decisioning. We have some eminent guests from financial services industry today who have an incredible wealth of experience to bring to the table today. They're right on the front lines navigating the massive structural shift in credit risk today. And that's why we have them on the webinar. It is our pleasure to see some enthusiasm from the industry, a fantastic turnout from this industry. I see a lot of risk underwriting and credit leadership joining us today from the industry. Just a few housekeeping items before we jump into the webinar. All your mics and cameras will be shut off, and only panelists will be allowed to speak, just to ensure there are no other disturbances during the entire webinar. I know there will be a lot of questions that will be coming from participants. So what we have done is we'll ask all the participants to put their questions in the chat box. We'll pick up the relevant ones and the most important ones. If some of your questions are not answered, we will address them probably after 2 or 3 working days. We will respond to them, but we'll ensure that we give you an opportunity. But put your questions in the chat box, and you will have your questions answered. Halfway through, we have also thought, we'll invoke a poll. We would want to understand more from the participants how they feel about this particular subject. So there will be a poll coming your way. Engage with us, and it will just take 2 or 3 minutes. We'd love participation from all of you. The results will be actually displayed on the screen. That's that. With that out of the way, Amit, I hand over things to you. We see that participants are still joining. Maybe we should take another minute, and then we should start off. Amit, I think we can start. Please go ahead.
All right. Thank you. Thank you, Praveen. And welcome everyone to the webinar on adaptive risk intelligence and continuous decisioning. I hope I'm very audible. Even if I'm not visible, I don't think there's much of a loss, especially because I don't even look like the picture that was just presented. So with that out of the way, very quick introduction. I'm the founder and CEO of Think 360 AI. We are a CAMS Group company now. We fancy ourselves as the onboarding and underwriting partner for a lot of BFSI institutions, all the way from public sector banks to the fintechs, to the innovators, to the traditionalists, everyone. And the working kind of behind the scenes for the last 12 years, 13 years has been one of the biggest, learning curves for us as an organization, that we believe that where credit as an ecosystem was 10 years back and where it is today, what we have seen is a tremendous amount of innovation in making credit accessible, right? A lot more of the operational refinements, technology advancements in trying to make the workflows come alive. But what we are moving towards is a lot more intelligence being added to those designs. And all of this is also happening on the back of a lot of what I could call as data democratization. So you have newer sources of data. We have account aggregator and the bank statement analyzers kind of driving a lot of these real-time data fetch, which is pristine and so on and so forth. We have also seen a lot of creative product design. We've seen a lot of creative workflow orchestrations that have kind of brought in interesting innovations. And as I stand today, I feel even more excited about what the next wave of AI will bring to the ecosystem. But, we'll get to all of that. We have 3 very, very, eminent panelists with us, people who've seen the industry up close, people who are making a delta impact in the industry. We have Ajit, Gigi, and Sanjay. I'll let them introduce themselves, so that I don't kind of steal their thunder. But all 3 of them bring in tremendous experiences and a variety of experience, which I think we'll all benefit from. So Ajit, you want to go first?
Thank you so much, Amit. Very good afternoon, everyone. My name is Gigi Umman. I'm the Chief Technology Officer of Havas Financiers. We are an affordable housing finance company focusing on serving customers across semi-urban and rural areas. We are present in 15 states slash union territories with more than 400 branch offices. In fact, over the last 2 decades or maybe more, I had the privilege of leading technology, digital transformations, and innovation initiatives for the organizations in the retail financial services space. At Havas, we are leveraging technology and data to make the financial services more accessible to customers, make it more efficient for the organization, and give better customer experience. And today's theme of discussion is extremely relevant, and I'm super delighted to be part of this forum and looking forward to an engaging conversation with all of you today.
Thanks, Gigi. Ajit, you want to go?
Yeah, thanks, Vijay, and thanks, Amit, right, for inviting for this webinar, right? So I am the one of the co-founder of AttackPay. We run the financial super app, right, where we are trying to solve the credit investment insurance product, right, for the mid and lower income segment, right? About me, basically, I have almost 20 years of experience, right? And before the AttackPay, I was running another startup in peer-to-peer lending space called Rupee Circle, right? And prior to that, I've been basically in the industry in the banking side, work for Citi and Axis Bank, and primarily the focus mostly on the what we talked about the data, how to use the data to whether to the marketing or the risk, right, and making sense of that, right. And I think the learning that I have when I was working for this two organization, right, so that is very was very useful when I started my own startups and primarily when we're trying to solve the lending problem, right, so the credit problem that people have, right, and I think that's a stuff for TalkPay for the last 4 years. We have been scaling our business, correct? And we are using the very innovative way, correct? And, with the different partners, correct, to underwrite our customers, correct, and provide the credit, correct. So we love to talk about how we are doing it, correct, in the coming, yeah.
Thanks, Ajit. Sanjay?
Yeah. Hi, good afternoon, everyone. Thanks a lot for inviting us and having a engaging discussion going forward for the next 1 hour. A brief about myself. I worked in the BFSI space for 2.5 decades. I have worked in various banks and BFCs across various type of products, including secured, unsecured, mortgage, retail, all type of products. Roughly last 1 year, we started a group of bankers, started this venture, which is LSP, loan service provider. So what we do, we exactly do the entire heavy lifting on behalf of the banks and NBFCs. Because we have the technology, we have the know-how, we understand the market way better than the normal NBFC. So this is the RBI guidelines and the DLG directives. We do the entire workflow management for them. And the loan actually sits on the balance sheet of the regulated entity. So idea is that keep improving the workflow basis the various data point which we gather. So till date, we have done almost 2.5 lakh of loan transactions ever borrower, and 3,000 CR is the volume of loan we had disbursed till date. But AUM is around 800 CR plus, and the volume has been very phenomenal. And we are able to find a sweet spot with not with so much of prime customer. So for us, the data point coming from the bureau and more from the account aggregator is of immense help to us. Because when you're in the bank or NBFC, typically, especially the larger NBFC, they have their own constraint. So, but when it comes to startup, actually, you can toy with so many ideas, make small cohort, etc., and then see if that goes well. Then you keep improving. So, looking forward to engaging discussion with all of you, including the audience. Thank you.
Thank you so much. Thank you so much to all three panelists. As you all can probably appreciate, in their experiences over the last couple of decades, plus what they are doing today, you see a certain curious and interesting mix of where the segmental focus might be, or how we are trying to all work towards, the modernization or enablement of the modern technologies within the lending ecosystem. So let me start with Ajit, you first. One of the things we are witnessing is this, what I call as the increasing share of digital originations, right? So across the stack, we see that digital. If I think about 10, 12 years back, we used to talk in 5 to 10% kind of range numbers. Now we have a number which is in the 75, 77% sort of all personal loans volume by numbers is digital origination. It does not mean that it is the same value contribution yet, because I think digital's focus has been the small ticket, high velocity, and you guys do it a lot. It's one of the things that you guys specialize in. So why don't you kind of just talk about what has been the interesting set of innovations, what has allowed you to kind of look at not just the first time risk assessment, but sort of ongoing assessment? Because one of the things one of the fintech founders highlighted, which I found very interesting, was that for us, DPD 30 is not the relevant number. Sometimes DPD 3 and DPD 7 also is relevant, right?
Yeah.
Because in the small ticket segment, things change very, very quickly. So curious to hear your point of view.
So, Amit, so basically, just want to, you are rightly said, right? The whole digital, the channel, right? Because when we started, right, I still remember that, like if till 2015, right, when I was working for the bank, right, still around the digital penetration of the acquisition was hardly 2-3%, right? So now in Patak Pay today, we have 100% acquisition that is happening from the digital channels. We have monthly almost like 25 lakhs application that we able to serve today, right? And out of which basically we almost give close to 1.5 lakhs loans that we are giving the new customer that we are giving loan every month, right? So uh, so what is the thing that the digital channel, that one of the things that I have observed personally, that okay, where we are in the space when the accessibility to apply became very easy, right? So people can easily apply, right? So now the real problem for me as an organization, when we try to basically underwrite the customers and try to get them, it is not about identify the bad one, right? Obviously, that is one thing that we have been doing, right? So underwriting. I think that the another thing that is emerging, that over leveraging the good customers, right? Because of the good customers today in the real time, right? Basically getting the multiple apps are there, because they can apply the loan, and the real time they can get the multiple loan, and that's and the way the ease has happened to getting the whole the credit, that is something is really alarming, and I think that is the way that we have been really working around. So today, the way we work is not just to whom to give or not, right? I think the question that became is that key, whom you to give, how much you want to give it, right? Because you don't want to make sure that they are over getting leverage, right? And secondly, obviously, when the amount that you've given, how do you manage it, right? Post, even when you're giving the loan, because you are rightly said that the most of the digital loan that we are trying to have are the short duration, right? Maybe 3 months, 6 months, right? And the idea is more about that ki, it is not about that ki I have given one loan and then I am done with that customers. So today underwriting is not just a door; it is just a journey that we are trying to do today, right? It is more about that ki how you are trying to understand the customers, correct? What are the initially maybe the initial data point, but that you have to also leverage that, okay, what is the exposure that you want to build up, right? And as the journey started with a few more signals that you are getting on customers, then you can have the multiple product pitching around, right? So that is definitely one of the things that we have been really working and trying to identify that key, how the customers the leverage is happening, right, on us, right? One of the data which we are trying to see, and something from the bureau that we found that the the 40% of my customers which are sitting in my DPD, right, which may be 30 plus, right, are what I find that the amount of limit that we give, they are over leveraged like 10 times the limit that given by some of the other the players, right? So that is really worrying for us, right? Maybe, and that's something that we have to identify, and that's one of the things that at Fatakpe we are trying to ensure that is still uh, the way the line management, the amount of exposure that we are doing, right? So that is something that we have been very focused on, right? And that is really helping us to basically scale up that, because we are able to ensure that the right exposure, the people are not getting over leveraged, right? And definitely the different data points that we are trying to use, correct, to do identify, because so small, when we are giving a small ticket size loan, right, I always start with that key. It's first start with the fraud to identify, because the fraud is became very important, because that is the first angle that we try to have, right, to ensure that you have the right customer which actually looking for a loan is coming to your platform, right? And if you can create a lot of checks around to ensure that you discourage the lot of unwanted people, right, who may be using other basically persona to enter into your system. You can discourage and basically weed out, right? That is something that we ensure that we have very right structure created from ensuring that whether the basically the KYC of the customer, the PAN and Aadhaar card, the customer, same customer who's coming around, and you have a right way to identify, having the face matches are happening, right? And the location from where their customer is coming around. So you create that thing. Post that, I think the parameters on the underwriting we actually encourage is that, because mostly when you're giving a small ticket size, the I think the ease is also that you don't want to a lot of information, right? So definitely the bureau is something that definitely help us to get the intent. But I think there are a lot of other information being a digital, so you're getting a lot of information maybe from SMS data. So I actually want to say that your product that has been very helpful for us to really identify that there are a lot of learning here around, right? What are the customer transactional data is talking about to really identify and getting more signal about which is the customers are getting leverage, right? Like bureau may say that the customer maybe has a score of, let's say, 750, right? But if you find that the customer has in the last couple of days had downloaded a lot of the digital app, lending app, right? That's so that there is some stress going on. He's looking around, leveraging things, right? So those factors became very important, right? And definitely the post, the idea is more about even people whom you are to give the exposure, right? You should also limit, right? What is the loan amount that you want to give it, right? Because the whole idea is not the one-time life value that we are trying to give the loan, right? So we are thinking about that lifetime we can actually extract the information and give the right decision, right? So maybe the initial loans maybe the smaller size, right? And once the people do the good repayment behavior, right? Those things, right? And post you can try to leverage and increase the limit, the line and the further the loan that given to the customer, right? So this is the whole at high level architecture that we have been following around, right? And that's the stuff that we are doing in Fatakpe, right? Yeah.
Very, very interesting. I think it will be very different from what Gigi you go through, right? Because yours are long tenured loans.
Yeah.
These are larger value loans. But even so, I believe that the pressure to be competitive, the pressure to give the right exposure, the underwrite well, fraud checks, asset value, asset, basically the chain of ownership, everything is a factor, right? And I believe that the housing finance as a space, not just affordable, but the whole thing, has been going through its own set of innovations to kind of become more evolved, more competitive, more automations driven, and more adaptive intelligence being brought in. Is how, I mean, where does it land?
Yeah, thank you so much. I think that's a very interesting question. And we being an affordable housing lender and operating from rural and semi-urban areas, for us, this question is very pertinent. And I was just kind of looking at our data points. Um, when you look at the non-salaried segment of customers, there are so many variances where, of profiles which we underwrite, and each profile is very different, right? In different geographies, when you look at a profile in city is very different from, rural space. Similarly, state to state, there could be a lot of differences. Um, and another interesting factor is that for a loan to get disbursed, right, for our business, it goes through the hands of at least 5 to 6 different functions, uh, right from the people who are sourcing files, underwriting, property valuations, legal assessment, the title assessment of the property, the risk function, then operations. So many different checks and balances. Of course, technology helps in making these processes far more seamless. I have seen over the years, right, things have become far more uh, competitive, and I would say is more seamless with the help of technology. But can technology replace human touch? For our segment, I would say no. Technology can augment it. And couple of things, right? So one, of course, the traditional documents for underwriting like bank statement, the Form 16, PAN, Aadhaar, all that are fine. They are very, very important. Bureau statements, they tell a lot of information. But at the same time, there are a lot more other indicators which now lenders have started looking at. So they go beyond static data points, right? And it was quite interesting that you quoted that people have started looking at not just 30 DPD or 60 DPD, now 7 DPD. We look at 1 plus is a very important KPI that we drive, and we do discuss them every single day. And that requires far more closer monitoring, right? So you need to move from, and of course the objective is primarily to be more dynamic, right? And do continuous monitoring, and I can very confidently say that, of course, there are a lot of indicators that you get directly from the data, but then you need to also build a lot of your business nuance indicators as well. And our bounce prediction models, which we have built over the years, right? Of course, they keep on getting improved all the time, but today we are able to predict the bounces at least with 80% more or more accuracy level. So what it also helps us is to proactively, of course, once you underwrite loan for 15 years, 20 years, and of course, these average tenure of these loans would go maybe up to 7 years, 8 years, or maybe 10 years. It's a long-term contract, right? So once you have onboarded the customer, of course, you have taken that decision, right? So you have lended money to the customer. So now what is possible is to make sure that you proactively engage with those customers, make sure that, you become the priority lender for the customer to repay money on time. So it becomes equally more important to, make sure that we have those indicators with us to proactively engage with customers and make sure that, the portfolio quality remains good. So it's not about just taking decisions fast and disburse money. We have to also make sure that we are lending money to the right people, and after you lend money, the customer stays with you with the right repayment behavior.
I think somebody had very, very nicely put it that in lending, the demand is never the problem. Your ability to collect is the problem. So being able to triage, being able to assess who you are giving the money to, and being very, very sure that you understand how to manage the scenarios where you have to collect the money, when things start to go a little left, little right, and so on and so forth. And what I'm hearing from both Ajit and JJ is that the monitoring, the surveillance, the review has become a lot more continuous, a lot more close to real time. I would not call it real time, but as close to real time as possible. When we talk about plus ones, plus threes, plus sevens, I think a fundamental set of assumptions going in there is that we are also collecting a tremendously higher amount of data than what we used to earlier. So in all our, all the different, integrations, pipelines that we have built over the last few years, the various data partners or tech partners that we work with, I think all of us are kind of in that point where there is more data coming into the risk monitoring and portfolio risk governance kind of systems. There is a lot more available at individual level. There's a lot more available at macro level, and all of it is being factored into risk monitoring. Now, Sanjay, I mean, coming to you, since you are probably now in the business of enabling a lot of the lending ecosystem as a LSP, so you probably were also like us. You, in a different way, you work with a lot of different credit institutions, and you would also build a bunch of these guardrails, data rails, tech rails to kind of enable. So tell us about what kind of trends you are seeing, how the use of data or tech evolving along in your sort of ecosystem and the clients you are enabling today. Sanjay, आप mute पे, you're on mute.
Audible? Yeah. So just to give a lowdown of what we do, and the few KPIs of our product. So typically ticket size around 30,000. A majority is all to the salary class. And customer typically, he has a thick history and thin history also. We're not doing currently NTC customer, but we like to do in future. But the point is that in the new ecosystem, you have to see the new underwriting, as the title goes, the version 2. How is it different from the previous underwriting is that now, since we are gathering as many data points, like you said, as possible, I have the bank statement with me, I have the bureau with me. So I'm dissecting all the data points which are available with me in the various, in the JSON form into various buckets. So once I have all the data points with me, I can reduce the number of documents which actually doesn't add so much of value. Effectively, if the customer is giving a salary slip, the same salary slip or paying in the bank statement, we question why do I need to capture another salary slip? Someone say that I want to check whether the guy is still working or not. He say we can also do a U1 data that is also coming with the API. So effectively, right from the start to the bottom, we are using around 20 APIs. Now this 20 API helps us in completing the entire journey in less than 5 minutes. Now this is a very far cry from what it used to be earlier. It used to take a couple of hours, a couple of days also, the underwriting. The average turnaround time, the yesteryear used to be a couple of days time, but now it's in minutes. Now all that is possible thanks to the multiple data point which have some predictive behavior. Now also we know that end of the day, it's not about giving the money, it's about recovering the money also. The money, my transaction will complete once I get the money at my own terms, not in the lag manner, but as I expected on the due date. Now, for us to do that, we do a whole lot of churning of the portfolio right from the top of the funnel to end. So, for example, 100 customer comes to me from top of the funnel. We end up giving loan to only to 5 to 10% of the customer. Now, which means rest 95 are getting rejected thanks to the various rules which is BRE we created in between, and all that is happening in a jiffy. I don't have to add so many manpower into it. No physical document is being taken, no scan document is being taken. So because my ticket size is low, I need to be mindful of the OPEX, operating cost which I am charging. Second is that number of people I have as well as the time. Now, turnaround time as low is coming true thanks to the data point which is coming from the one from road, two from the account aggregator BSA. Now here, I would say that bureau always has a lagged information. There's always a lag. But what comes from the bank statement is of a real-time information. So typically, if you see the rule of the lending remains the same, whether it's digital or non-digital, I need to check the character, capacity, and the cash flows. Character more or less is coming from the my as far as the capacity as well as the cash flows are concerned. I have real-time data available with me. I can dissect the data coming from the bank statement as much as possible, and I store the data. Then I store the data, and some of the customer will do well, some will not do well. This is the correlation, and I can improve my algorithm day in day out. So that's what we do. So idea is that, and also we are currently operating around 10,000 pin code across India. So we don't lend to loan to everyone. Because at the end of the day, we also have a huge responsibility on behalf of the lender to collect the money, and money goes back to them, and we cover a small bit of charges in between. So very mindful of the fact, one is the TAT, second is the quality of the decisioning, and third very important point which is possible in the new ecosystem is the early warning signal. Now EWS thing, which again yesterday, yes, even if you see the various circular regulator, they are more talking about the MSME. Now, I'm not in touch with the customer after giving the loan to me, but thanks to the bank statement and the real-time information available for me, I can pull the statement from me from the bank statement every now and then. Plus, I have a bureau alerts also. A combination of that, a triangulation of that actually gives an idea which customer is likely to default more. And then accordingly, I maneuver and change my machinery of the collection to those such a customers. So maybe my follow with the customer will start early for those customers who are showing some kind of bouncing, which is not there now, but bouncing has come in. And maybe the guy actually is taking out money too much from the bank statement. Earlier, his average bank balance was slightly high, but now thanks to some event happened, the money has gone out very quickly. So that gives me another leeway that this is the customer which is potentially like to either to default or delay. So accordingly, we'll line up the field visit. We'll make sure that these the customer need to be handled differently. So effectively, I would say, thanks to the multiple data points, thanks to the real-time data availability, we are able to understand the customer and have a prediction on his default behavior much quicker, much earlier. So I'm able to bring down the cost. I'm able to standardize the underwriting. And typically, what happens that if I do subjective underwriting, typically I'm taking a lot of documents. Whatever policy you create, whatever BRE you create, every underwriter will behave, will see the information very differently. So there may be some broader, unanimity, but still the subjectivity comes, which is not very good for the portfolio behavior. So once I have a data point, and data end of the day, there's a fear. One of our founders says that either you believe in the God or in the data. So we believe in the God data. Apart from the God, we are all God-fearing people. So we are able to reduce the number of credit people actually who are looking at it. Almost 70 to 80% of the customers are going straight flow through, which allows me to process with a similar kind of workforce, much higher transaction. And without compromising the quality of the credit quality, I'm able to have a pristine kind of credit quality at the end of the day. So that's what.
Amit, you are in mute.
Sorry.
Sorry.
Voice not
Thanks,
clear?
Ajay. No, okay. So I was saying thanks. I'm trying to just wrap my, inferences and thoughts around the three, sets of inputs we just heard. So I think what we are witnessing or what we are seeing is that there is that gradual high level design automation of how the data is collected, how it is being fed into the various BRE scorecards and rating models that are there. There is still, that sort of, let me say it's not going to be 100% STP yet, and especially as the ticket sizes increase. In secured lending, in housing finance, and various other forms of secured lending, I think there is still a certain amount of judgment that is required, and maybe some of the data flows are still not, because multiple departments or units within the approval flows are involved. There is handoffs, but I think the handoffs are manual, but they are still reasonably automated than they used to be earlier. And we are all compressing the TAT. That seems to be one variable that everyone has worked towards. That the TAT is no longer what it used to be. So what was 2 days is probably 2 minutes. What was 25 days in housing finance is probably 2 days, and so on and so forth, right? So a lot of those TAT compressions are happening, but that has also what has happened in the process is that we are looking at our probability of default models, our scorecards, our EWS systems a lot more closely with the various data integrations that have happened. And what we also have is an avenue to kind of change the way we collect or cure our portfolio on a continuous basis, much more differently than what used to be the case earlier. In all of this, I think there is a sense of monitoring exposure, over leveraged, multiple credit inquiries happening in quick timeframes, leveraging things like account aggregator data to get more continuous bank statement, which is a truer representation of the financial health, as let's say the earlier version of only looking at bureau scrubs, which used to happen periodically and with a certain lag in the data that was being reported. I think there's a lot of small, big innovations that have happened in the way underwriting is currently happening. The question that I probably want to now focus a little more in this next section um, is more about continuous decisioning, because I think whenever we acquire a customer as a lending or a broader financial service institution, uh, our hope or our plan is to not do just one transaction with them, but to do multiple transactions with them and with their ecosystem. And I will want to hear, maybe short inputs or two from all three of you around if you're we know what is available, right? And it includes the current set of AI technologies and capabilities also, which have far more nuanced inference capabilities available. If somebody's getting into this space now, if somebody's rebuilding their underwriting infrastructure to modernize it, maybe, or to just replace what has served them well for the last decade with something completely new, what sort of first principles that you will go with? Is it more around data? Is it more around adding more intelligence? It is more around continuous monitoring, because that creates an extra skim, extra percentage benefit on top, your ability to price differently. What would you say as the first few, sort of first principles thinking going to look like for someone who's starting their underwriting infrastructure build out today? Gigi, you want to go first?
I don't mind in doing that. So it is not, Amit, the question of or. I think it's the question of and, because we are in the business of lending money, right? And it's important that the customer repays money on time and the customer stays with you. Because for us, another big risk is the balance transfer, right? Because the competition out is so high. So I think all the three dimensions that you spoke about, right? You are assessing the customer rightly, making sure that in our case, like the property's valuation is right, the title of the property is clean, the customer doesn't, is not potentially going to do any fraud with you or any past track record of any fraud attempts. The customer, then ongoing customer's financial health is very, very important, right? So in fact, I was quite, interesting. It was quite interesting to note that now the account aggregator solution is also giving you ongoing monitoring capability if you take the long-term consent. So, and that's an authorized mechanism with which you can do that. Of course, this is new, relatively newer. So for lenders like us, whose tenures are longer, it will take some time for us to really reach that level of space where you can fully monitor the customer's banking behaviors. But then there are a lot of non-banking, segments also, right? So I think, and then the last aspect I spoke about is making sure that your customer is engaged well with you. We engage well with the customer. There are so many different indicators which we need to look at, right? Right from, how the customers are interacting with you, right? Through your digital channels, by your branches, contact centers, and then it's like, the situation of the microeconomic situations, the sectoral issues. When the microfinance space went through a lot of struggles, right, in the recent years, we were very, very watchful of our portfolio in specific areas, segments, making sure that your rigor of engagement and, the collection activities are very high, etc. So I think there is no single single formula that I can suggest, but I do think that there is a value to design a well orchestrated platform, which is very well connected, which is not just only with your internal systems, but also with the external ecosystem, with very good blend of your data capabilities, and of course the ability to translate that data into the right decision, right? So I think there's no single formula. It's a mix of all little ingredients to really form a good underwriting and portfolio monitoring systems.
Ajit, Ajit and Sanjay, you guys are on the more higher velocity ecosystems. So the question I'm going to force the question on you guys is your higher money going to be spent on building a more robust data side or more robust intelligence side if you're starting today? Because I think we have to optimize our investments, right?
So, Amit, I think, I believe a lot of people are maybe thinking about jumping into the lending side, or some of the people maybe in the organization thinking about what to do, what different stuff that they should be doing, right? See, I always start with I think the audience, right? So I think what type of audience that we are talking about, right? Because that is very important era. See, when we're talking about digitalization, right? So when the reach, right? So today we serve almost 20,000 pin code, right, in India, right, where the people can access our platform and can apply for the loan and get a loan, right. Now it's very important that when you have such a great reach, right, the type of people, right, who was earlier not accessible to the credit, right, like the typical earlier, like maybe think about 10 years back, right, the people typically are the people are salaried, having good salary, right. Maybe they are looking for some sort of loan. Maybe you can get some information, their banking information, you're getting a good salary. It's much easy because he's coming from one. And there are very few lenders also, right? Maybe couple of lenders, right? So that one, that taking the decision is different, and the type of decision that it takes is totally different, right? Because now the type of customers are also different, right? I will take you a very simple example. primarily, let's see if I see the opportunity, there are a lot of opportunity MSME sector, right? So self-employed sector, there's a lot of the smaller segment, which are actually really need the credit, right? And actually those are segment are really deprived of the credit, right? Because they do not have the proper data points, right? The point that you're talking about to gather data, right? But a lot of things that they will not have a lot of data points, right? They have not taken, let's say, take example, they have not taken any loan in the past. No one has given them, right? Now, if you know that this set of customers we are doing well, right, in the business, how can you provide the credit? So now there is a very typical way and I actually just want to give you a very example that like when you're today, I think the banking is still the coming of the account aggregator and the data that you're trying to gather, right? The way you see the data is very important, right? And that is correlated with the customer segment you're talking about. Like if a salary, you can really go, okay, this is the guy, the salaried, maybe the salary is getting credited every month, and that is pretty easy task, right? Now the people who do not, which are self-employed, right? They are not getting the proper or one particular salary or amount coming credit, but they are getting in the multiples, like the UPI payments coming to their accounts, right? Now I think very very interesting that is about the like really if you want to really sense about the how the someone is doing, how the business is doing, right? There is a lot of things the data talked about. Like one of the things that we are trying to do is like the velocity of the transaction that are happening, right, at a particular area, right, particular shop. It's like someone having the bank statement, and if you see the multiple the credit the credits coming to account, and the way the velocity that the credits coming around, that can also be provided if you can use those information, right? And that's the point that I always focus on, that key. If you just correlate with what type of customer that you're targeting and what the data that you're talking, the data that's here to within that data, how you can build lot more intelligence, right? And I think a lot of stuff that is becoming easier, right, now through the AI and other stuff, right? So I personally believe that key data gathering is always there. I don't think that key as a being a data guy, I'll stop whatever. But given the regulatory constraint that is coming around, right? I think I believe that key whatever the data which is easily available, let's look around the what is the intelligence sitting there, right? With the connecting with the what type of customer that we're talking about, what type of the customer that we're targeting, right? So
Very interesting. Thank you. Before I get to Sanjay, one quick thing. I think we'll just do the poll. Praveen, if you want to kind of quickly launch the poll for the audience.
Yeah.
And Sanjay, before we come back to the same similar question for you, the one thing I do want you to address, if possible, is that given that most of the current backend infrastructure, the tech infrastructure, is linked to the idea of LOS, LMS, CRM, etc. People intelligence infrastructure for continuous decisioning or a lot more nuanced first time underwriting, as you were kind of elaborating in your earlier answer, that there is so much happening. You too use different data sets at different APIs at different points in time. How does one think about, or where does one think about architecting that sort of infrastructure? And, is it still in the same LOS, LMS, CRM sort of design, or is there something else happening here?
I think that I echo roughly the same view which Ajit said. One, we need to aggregate as much data as possible, and data is the new oil. So whether the customer accepted or rejected or WIP, every possible data I need to have in place. So before coming on to the point, I just want to dwell one or two lines on that. Whether the customer is coming to you and customer use the data, every bit of data need to be stored. And data need to be stored in such a manner that you should be able to aggregate, segregate the data and dissect it to draw some future trend. So the customer, for example, you have rejected the customer, but customer has taken a loan from someone else because you have a bureau history, you can do a bureau even purge also. So by doing that, if the customer you are rejected, customer taking loan someone else, he is doing well. So that's the opportunity loss for you. That would be possible only if you have stored the data and you can question your own philosophy and keep improving upon that. That's one. Second is in the, I think our biggies, banks and NBFCs, possibly as far as the retail segment is concerned, less than 50K or less than 1 lakh, majority of that origination evaluation is happening from the fintech NBFC side or only fintech side, because they are able to master and understand a middle path. Now, what is the middle path? They have created their own LOS, LMS. Now that LOS, LMS actually is strengthening the current, the existing LOS, LMS in place by the biggies, for example, Finno of the world. Now there are so many companies which have come up. They are offering that we have our own in-house for the reason that we want to have control over the tech. We make sure that every changes enhancement etc. can be done within Jiffy. I know what I'm doing. I'm not dependent on the third party. But the current LOS LMS is far superior. It addresses the embedded kind of finance. Just to give an idea, because the current system is changing, but the traditional LOS LMS has not changed. So even if actually you take the traditional LOS LMS etc. and try like to make some changes etc., the time taken to change, make a change etc. is hell lot of long. But here more time, more loss of time, and more you are losing the time and energy both. So idea is that you tailor-made the LOS LMS as per your embedded finance, as per your target segment. So just to give an idea, now in India, we are large population, the largest in the world now. But as far as the credit penetration is concerned, at the bottom of the pyramid, especially of the hawker, retail, etc., is minuscule. Now, those set of customers are not fitting into the criteria of the banks and big NBFCs, large NBFCs. Now, here there's opportunity. Now, for example, I'll just take example of a QR. Now, the customer may not be there in the bureau, or the customer has very thin history. But because by virtue of the QR statement, the digitalization of the transaction, monetary transaction. So instead of me first taking and exchanging the goods and services to the money, now I'm using it through the QR code. So more QR transaction, more velocity, more veracity, depth, etc., etc. We are able to find a model that what is the average transaction and the value of the money will come to the customer from what type of segments. Since I know that, I can tailor-made the product in such a manner that before the settlement happens in his bank account, I will take my EMI or EDI directly from his QR directly. So which will give me greater comfort. So one, I can charge slightly higher rate of interest. So this set of customer will be totally no from the bank side or from the NBC side. But here I'm able to arrive at a formula thanks to the data segregation, thanks to data acquisition, thanks to the intelligence, where we are able to cater to those segments which are actually more inclusion in the market. So such time a customer typically would touch me not by the largest player. But thanks to the data availability, freely easy accessibility of the data, of course, within the DLG guidelines and the banking regulations, we are able to access those customers much faster, much quicker. And in the realm of keeping that aside, the assessment and the ability to give the credit to the customer is much quicker. That allows us also to bring a larger base in a much smaller form, much smaller time. For example, the entire industry for the PN is growing by 20% CAGR, and we are growing by 20-25% CMGR, compounding monthly growth rate. Because we are able to find a niche where possible the customer has a history, but slightly impaired history, and somewhere we have to find a sweet spot. Those things are possible only when I am able to use the past understanding and the intelligence and with the study and able to store the data into various database form, which I'm using on and on.
Lovely. I think my key takeaways, and I think this strongly resonates with the body of work we have done in the last 10 years or so. Having a solid design as well as control over how the data is coming in and how is it stored and managed over multiple life cycles of a customer, not just once. In one of the portfolios, we ran into the system that the LAN IDs were getting refreshed over a 5-year period or something, and we were like, oh, now we can't figure out what happened in year one versus year 5 and year 6 because the same ID is getting repeated. So a lot of those simple things, but having quality data is one backbone. Let's call it that. I think to Ajit and JJ and Sanjay's point, segmental clarity should drive part of how we design the systems. So what works for segment A does not necessarily get copy pasted to segment B. The kind of data sources that are very interesting for salary does not work necessarily for self-employed. The what is absolutely required in affordable finance does not work for equipment finance, and so on and so forth. There's a lot of, I think, the segmental nuance and the product nuance comes into it. That probably is a good starting point. But to get to a more intelligent infrastructure, I think the data, the way it is coming in, and how do you maximize the value of every incremental piece of data? That's one thing that Ajit spoke at length about. It may not be about having hundreds of sources, but if you have a source, getting the most out of it and how does it fit to the segment that you're going after, I think that should be one of the takeaways. And that's where one of the areas where, the few things that we probably have been doing, let's say, the product that Ajit you mentioned, Algo 360, the device data intelligence versus what is happening in the account aggregator intelligence versus what happens with some of the proxy signals. And I think Gigi, you were mentioning some of those, but we even look at, let's say, things like how a particular customer might be defaulting or behaving on their electricity bills, or what's happening to their, prepaid, postpaid recharge behavior, what's happening to their consumption behavior on certain, categories. Are there intelligences built there? Am I taking informal loans from my friends and I'm repaying them, which might become visible in my bank statement, that I have somewhere I have taken 50,000 or 70,000 rupee from, but I have paid it over last 3 months in 20,000, 25,000 kind of. A lot of these are pseudo signals, which are not necessarily historically were not definitely not present in bureau data, and all of us are kind of evolving towards building models, scorecards, intelligence infrastructure, data infrastructure that sort of supports that. With a time check, we are at 3:53, and I want to quickly cover these the survey responses so far. I mean, where does your risk system detect distress from borrower's account? We see that the responses are going higher towards things like hard bounces or EWS systems that are starting to get implemented. I find the EWS part very fascinating. I would have expected that number to be lower because it's a more I think tech first institutions are probably doing it. Traditional institutions are very driven by the other touch points that they have is in our learning, but fantastic to see that. Biggest barrier to continuous post disbursement monitoring, people saying recurring consent requests. This falls in that AA account aggregator bucket, I guess. We have comments about cost and operational complexity, which will always be true, especially in lower ticket loan sizes. You can't increase your cost beyond a certain point just to kind of, the math starts to go wrong. Uh, the third question was about what is state your primary post disbursement risk signal, which is coming from delinquency and collections data for almost half the respondents, which I find interesting. I would have thought that the cash flow bank transactions or the recurring fetches, because it links back to the earlier question, would have been an interesting observation. Bureau refreshes still are there, customer behavior signals are still there. What percentage of the active portfolio is monitored beyond bureau data? That is 50% plus, which is again fantastic. But it's well distributed. We have people in all the buckets. My personal belief, and that's something that we heard all the panelists also talk about, is that this is one bucket where beyond bureau data is starting to become very, very interesting. The last question we had asked people to poll on was the driver of underwriting performance over the next 3 years. And this is important because I'm going to use it to the next and last section of the discussion. What is the biggest driver of underwriting performance over the next years? Identifying behavioral intelligence using AI pops up. AA pops up. Those are the top two responses. Better usage of using coverage of AA FIP network are two things that are popping up in the responses there. So with that, I actually want to kind of take a couple of minutes, short sort of responses from all three panelists on where in the next 18 to 24 months, from a forward-looking perspective, um, do you see the differentiated lenders, the ones who are using a lot more interesting adaptive intelligence, adaptive underwriting, where are the buckets where they will choose to differentiate? Let's say if a chief risk officer, if you are advising a panel of CROs or underwriting heads, what sort of, in the 18-24 month window, what sort of changes would you recommend for them, or what sort of one or two things you would ask them to do? So more forward looking, not the history. So this time, let's start with Sanjay first, and then we'll come to GGM. Ajit after that.
Yeah. Ajit, I would say that, for example, if I had to advise heading anyone heading this in a lending organization, first I need to advise that if you dissect your portfolio into the small ticket and the last ticket. So anything less than 5, I would say, is a small ticket. Use technology as much as possible. Entire underwriting should be loaded onto the workflow based, BRE based, rather than by the document based. So as the ticket size is going up, you need more Hawkeye. Possibly all the data point will not be available. For example, the mortgage, like Jiju said, here largely the underwriting actual is a look and feel, and state laws. This state property laws etc. doesn't allow you to translate that into the digital aspect. So digitization is happening that way. Retail lending is concerned less than 5 lakh. I think that market will be cornered more by the fintech NBFCs, the fintech players. So that is one. Two, store as much data points as possible of all the customers which are coming from the top of the funnel to the end. Three, as far as the BSA is concerned, the account aggregate is concerned, I think we are not doing enough justice to the amount which are available. Currently, if I see and take a lopsided view, we are only seeing the bounces, we are only seeing the income and the expense and the FOIA. I think the real magic lies far beyond these numbers as to where he's spending the money, for how long the money is staying, what is the frequency of the his money going to the various players, etc. Whether the guy is into gaming. So a whole lot of things. Every data point, you need to make it various cohorts and see where exactly this customer is fitting in, and try to bring some kind of predictability in his behavior and whether it has some correlation with the future losses or not. So I would say segment basis their understanding and the risk appetite, they can get into secured, unsecured, whatever. So my only advice would be that dissect the data as much as possible, store it in the manner which you can retrieve it, and also do some kind of data mining. Lower the ticket size, more the automation, higher the ticket size. You need to have a dual approach, a phygital kind of approach. That's all.
From my side, what I'll suggest that I think pretty much I think still the whole the A network thing still a lot of people earlier used the bank statement, but there was always a barrier, right? The digital lender like us, right? Uh, they're always looking around at how can basically replace the bank statement from the SMS another data point. But now the given the A framework is the way it is emerging, the way the seamless things are happening, where the participation has been increasing, and even like all FIP and all the player like you guys are also innovative, right? To make it the process very smoother, right? Because there's tons of the hidden data. Very frankly, even if you the banking, what do you talked about the banking, right? So if the banking data is there, right? Beside the bureau, right? Banking is, and if you're able to access it very easily, right? There are lot of work still has to be done, and there are lot the improvement on be it on a underwriting, correct, and be in the correcting the customers thing, right? Like even like when we're talking about like for us also, right? When we are trying to give the small ticket size loan, we generally avoid the banking. It's not that we don't want to take the banking. It is just that it is a process where the customer will give or not, right? But I'm finding that we have been doing some experiment, and we're finding that people are today with the current A structure, they are ready to give that the access because they don't have to download somewhere the statement and upload it, right? So that has really doing very well, right? And the penetrations of people going to this. So I think but the way I will suggest that this is again the fundamental thing is still the remain the same. So if you are able to get both intent and ability data, let's get the data on this, work around that, correct? And pivot with the, as we talked about, like for the people like the short term the loan that we're talking about, where we may be pivoting with the basically more on the monitoring side, right? Like so the early signals, right, that you are getting from the like little lot of account, like post disbursements also, right? The multiple funding is happening, right? Now those thing information from account aggregator, you can get that, and you can be very active on those side of customers who is most likely to bounce or over stress beyond care, and you can have strategize the different strategy for to how to basically collect that. I think there a lot of work has to be done. I think a lot of some player have started doing it, right? As there is still the maturity for this product. So let's keep the way we are today on the bureau side. I think that I think another 12 months or 18 months we'll on the bureau side, on the account aggregator side, right? So.
And Gigi, when you kind of drop in your thoughts, because yours is a very, very different portfolio, I'm also curious if you guys are seeing a role for emerging AI technologies in the overall ecosystem, because lending is supposed to be conservative and AI is right now too exciting.
Yes, absolutely. So I would like to add a couple of points to what Sanjay and Ajit have said. So if I were to give my priorities, there are two areas that I would like us to prioritize in the next 12 to 18 months would be one, of course, there will always be yield compressions because the regulator will continuously, they are very watchful of the interest rates, and so there is, the market is getting competitive. So you need to make the processes more efficient to make sure that we are able to operate at lower margins. So, the cost efficiency at every possible level. And of course, giving good customer experience. So that's on one side, and AI, data, automations, um, the large language models, the Gen AIs, agentic AIs, they all have BREs, they all have great role to play there. So that is one aspect I would like to say. The other aspect that all of us need to be mindful of is that the DPDP rules are going to become mandatory in the next 12 months. And how this is going to impact the whole ecosystem is that this Indian financial services industry, especially on lending space, has done phenomenally innovative work together, fintechs and the lenders together in the last several years. The regime is going to change when it comes to a space with so much of data privacy rules. I think all of us need to make sure that you have consents in place. The freedom with which we all have been able to access customer information in the past were very different. So the situation in future is going to be very different. Although there are, provisions given in the regulation and rules that, that the lenders or, the financial um, have the opportunity to keep track or get information, maintain information, all of that. But then there are very clear guidelines as to how the consent needs to be taken, how the consent need to be used, what information, when you can use that information, when you should cease using that information, information lifecycle management. All of that are going to become very, very very, very important. So I think the industry need to really, work towards governance and compliances in that space, data privacy side. And it's very important because we have been relying heavily on data, right? And the in the past era, right, you've always been people largely relying on the data which are not directly coming from sources, right? And of course, now with account aggregator being consented and data coming directly from the source, it's a great thing. And there are so the lenders need to look for the sources are more authentic, consented, to be able to kind of leverage these data points. So that's the second aspect I do think is very important for all of us to pay attention to. And of course, the last piece is that customers are going to become more and more demanding. The regulators are going to become far more stringent. So we need to be prepared in that space. So these are the three predominant areas that I would definitely, of course, growth is very important. That will happen when the efficiency goes up. You will be able to deliver more, from a business value perspective.
Lovely. Thank you so much. Those are very, very interesting thoughts, CG, because as someone who's built his career on data, as an analytics person, as a data analytics guy who started a company, the one big change that I expect will happen in the next 12 months, it's a big focus of all the work we do today, is how will we respond to DPDPA? We just concluded a data discovery exercise for a client where we realized that contrary to what the leadership believed, the company's, the fintech's data was stored in 900 plus S3 buckets. And even the data analytics team or the DevOps team had access to some PII data. And I was like, why do you have it? You guys don't need it. And the response was that we never bothered to check who has. And you have purposes codes around it and you have sensitivity around it. And that's a reasonable input to what maybe the next 18 months of this adaptive intelligent infrastructure versus overall banking data infrastructure or credit data infrastructure, how it's going to evolve. I think it's a big question that I probably requires a separate conversation by itself. But just trying to again summarize a few things that we heard. We heard the point about the segments and the ticket sizes maybe having a role to play in what sort of innovations or automations should be your focus as a risk, as a tech person. So to Sanjay's point, smaller ticket size will probably see a lot more automation, while the larger ticket sizes may see a lot more organized guardrail-driven workflows, but intelligent workflows, let's call it. There will be the need to, at this point in time, I think we are still in that era where more data, organized data, store as much as you can, organize as well as you can is very important. But somewhere in the next 12 months, I think making sure that we have the right consent artifacts and purpose artifacts to it so that we continue to use them in our models, we continue to use them in our operations. I think that risk is taken out of the equation. That is important. All of you believe that while there is data, I think there's a need to kind of extract more juice out of it. So the BSAs are there, the AA data is there, the pipelines are there, but are we doing the most we can with that data? That continues to be a big focus area. And I think, again, from our own product sort of life perspective, that is the one critical feedback that our Amaze team keeps working on, right? What are the nudges you can give us? Are there continuous alerts that you can provide us? So that continues to be, and these are all kinds. They are sales marketing, they are upsell, cross-sell, they are early warning signals, they are opportunity, hot leads, all sorts of things. And lastly, I think Gigi made a wonderful point about how the market will continue to be competitive. There will be yield compression. There will be demand for better service, while there will be demand for better controls from the regulator. So those things will probably drive the set of, I guess, changes that we'll see. Since we overran by 8 minutes, I will probably just look at one of the questions that we have
Amit,
from
we
the
have a
audience
couple
is,
of questions. Amit, we have
yeah,
a couple of
Praveen, do you want
questions.
to
One
just
is
go?
from, yeah, we are overshot by time, but I think we can quickly take this. Can you, Kirti asks, what can you share an example where AI helped you discover a non-obvious insight that you likely wouldn't have found otherwise, and the ultimately made it its way into a production model? And then we have one more question.
Anyone wants to go? If I do that, it'll sound like sales pitch.
So I will give you one of the example. Basically, though it may not be the model on the credit risk side I talked about, but one of the thing that was the image recognition, right? So like the facial recognition, the thing that we do that when we take the liveness and we take the selfie and we try to basically try to basically see that from the Aadhaar, what are the data point that I have to match or not, right? So we used to have the model, and I think that model has been evolving, right? And the last two couple of years, if you see that there are a lot of works on the image side that are happening, right? And which is helping us to make the model even better, right? So what we used to be 2 year back, right? Now the true identification, it's earlier what is happening like almost like 5 to 10% of my buckets, right? Basically, the customer, we have to do some manual filtering, right? Because there's a model which is say the accept or reject, but there is another 10% bucket where we want some manual intervention where trying to customer see it. Now that number has come down from the 10% now to 2%, right? So because the model has evolved, right? So that is, I definitely say that the all this what we talked about the AI models with so many data points, right? I think it is the models are evolving, right? So that's one thing that I can definitely talked about. So which would have taken longer time, right? So earlier.
Yeah, I think if I have to top it off based on our risk analytics set of experience, especially with alternative data, a classical example of non-obvious insights, which we are traditionally not bothered with, is that if you start doing merchant tagging in a bank statement better, something as simple as how much are you spending on your discretionary purchases like dining out, the percentage of your income that is going there, uh, or the percentage of income that goes into gaming apps. There is a point of time where this information was not available to us. There is a point where it became available to us when we saw the top-ups happening in specific type of wallets or apps. Um, People who have greater than X amount going into gaming apps are NX more likely to default on their payment. And I will leave the X and NX to your imagination right now. That's sort of somebody else's prop scorecard model at some point. But in high velocity sort of models, and it came from this very weird insight about their customer segment, where we were looking at practically tier three, tier four customers, and the same device is used by the parent as well as the, let's say, the child in the family. The child uses it for gaming, maybe, and sometimes some part of that, because you can approve a UPI transaction, etc. Children these days are very savvy, so the there was a certain amount of money that was going in a particular population cohort into gaming apps. It was interestingly useful in terms of identifying a segment where we did not want to approve customers with a higher than X proportion going, a higher than X amount going into gaming apps as a scorecard variable. Does not apply to 100% of the population, but does work beautifully. Any
Amit,
other
I
question,
guess we might have some time to answer another question. Akshita asks, since there is a limit to how much banking data we can access from AA framework, how many months, years of bank statement behavior is imperative to analyze a small ticket MSME lender?
Ajay, Gigi, Ajit, anyone wants to take that?
So currently we are using
Amit,
6 month data, correct? Yeah, but it depends.
Amit, also, I think it's depending on which segment of the MSME is into, whether it's cyclical, non-cyclical. So if he's into cyclical, we need to be mindful of the period of the data. Longer the period, the better. But every time we may not have the advantage of the longer bank statement. So more the bank statement, longer the period, the better, especially with respect to the seasonal segment. Also, we also need to be dissect further whether it's a manufacturer, wholesaler, retailer, service provider, etc., which typically are cycle agnostic, some of the industries. So based on that, anywhere between 3 to 6 months is the minimum, I think, the period you should have. But if you can larger the ticket size, longer should be the kind of duration of the bank statement you can do. But for a smaller ticket, you can't expect a 1 year bank statement he will submit to you.
Gigi, you have any inputs based on your other experiences also, not just ours?
No, I think for when you say small ticket size, I'm not sure what is the size. Is it like 50,000, 1 lakh kind of size, or maybe in MSME, maybe 2, 3 lakhs kind of ticket size?
Yeah.
Generally, what I've seen as a practice is that minimum 6 months bank statement, it is good to review with a combination of the bureau statement, because bureau statement will definitely give you a lot of indication about the behavior of the repayment behavior of the customer in the past, if the customer has taken loan before. And combining that with, your other indicators, right? The customer's profile centric assessment, cash flow assessment, combination of all need to kind of, give you a result. And I do think that 6 months is something that one should look at when lending, because at the end of the day, 6 months will still give you some amount of 3 months, I think is way, way too short. 6 months will give you still a decent visibility. I would go to the extent of saying 1 year will give you clear cyclical visibility, especially if the customer is not salaried, right? So because you have certain seasonalities in the business cycle. So minimum 6 months, but of course, 1 year would be more ideal.
So I think in the AA framework, my view is very similar, that because it's A and it's kind of a single press consent, etc., etc., I would operate in the 6 to 12 months sort of time frame for collecting the data. In the PDF universe, it was a little more complicated because the number of pages used to increase, the processing time, potential errors, annotations, everything. But I think if the source is AA, I would probably, even depending on the ticket size, default to 12 months if possible. A smaller ticket, yeah, 6 months is usually fine. But then small ticket is a very, there is a relative grading here also, like Gigi was saying. If we are talking about 50,000 to 2 lakh, that's a really small one. But some people we've seen looking at small to mid ticket size, going all the way up to 20 lakhs also in the SME segments. So definitions matter, I guess. And eventually, as underwriters, we are only committed to being sure about the loan we are going to give. So it's okay to ask for a little more, I guess. But
one more aspect, maybe,
yeah,
sorry, one more aspect, Amit, I would also like to add is if it's collateral free, right? If it's not a secure lending, then the complexities are very different, right? So you need to really look at the customer's behavioral aspects also. So yeah, that's also a very important variable to look at.
With also just to add, for example, if you self, not so much of a salary, where which is underwriting is much more simpler, less footprint, etc. You have other data point, which is the bureau and GST So triangulation of all the three sources actually make a perfect cocktail. That's one. Two, for a smaller segment, which is a MSME, anyway, you will not find much of a transaction in the bank statement. So over relying on the bank statement will not be the right approach. You have to triangulate that with the look and feel plus the bureau. And third is what is coming from the, if he's filing the GST return, yes, it is. So triangulate all of three and then make a judgment out of it based on the policy approved by the board.
Perfect. All right, I
With
think,
that wraps up our questions.
yes, I was about to just thank my fellow panelists and for a very, very interesting, engaging conversation. Lots of things, lots of notes that I have taken. The idea is to learn. The idea is to keep evolving whatever we are doing. And there's been a lot of comments which are kind of, one, what is happening, and second, what we should expect going forward. But I think it suffices to say that we are looking at an evolving, adaptive, intelligent infrastructure play in the next 2, 3, 5 years or so. A lot of the foundation rails are working beautifully. The data rails, the tech rails, a lot of the intersystem integration and workflows are a lot more mature than they used to be. Having said that, there are very, very foundational set of, I think, differences depending on the product and segments that we talk about. So what data, what tech, what AI, what model, what algorithms, we'll have to kind of look at our own portfolios in that sense and choose our strategies for the next 2 years wisely. Thank you so much. Praveen, anything from you? Otherwise, you can.
No, I think it's been an exciting conversation with everybody. I really thank all the participants and all the panelists as well. We look forward to the next session. But that's it from our side. Thank you so much for joining this webinar. I think we can close.
Thank you, everyone.
Thanks a lot.
Thank you, everyone.
Thank
Thanks
you.
a lot.
Thanks, Amit. Thanks, Praveen. Yeah.
Thank you.